Hello and welcome to the OneRoof Property Panel. I am your host, Frances Cook, and today we're going to dive into everything you need to know about what's happening in the world of property right now. So to introduce our panel, we have today for you, we have Peter Thompson, the Managing Director of Barfoot and Thompson. We have Carmen Viselic, the CEO of Velocity Global. We have Rupert Goff, CEO of Mortgage Lab, and economist Tony Alexander. Now, Carmen, we'll start with you. When COVID hit, it got very pessimistic for a while there. Nobody really knew what was going to happen, but there were some predictions of the housing market really cratering. What do we know about how it's looking now? What are those numbers looking like?
I guess, it's important to say, how do we look at the numbers and how do we actually derive insights that are evidence-based and not intuitive or gut feel or guesses. And so the numbers now are looking actually that we're relatively steady. So surely growth has slowed down. It's sitting at around just under 1%. But we have, not had that drop off a cliff that many had anticipated. And how we're measuring it, I think, is really, really important. And we had to create new ways of looking at this because we've never before had the market completely stop and go into a lockdown. And so what we did is we drew a line in the sand on the 25th of March to say, actually, this is our pre-COVID market and this is our post-COVID market. And we valued all properties nationwide with our automated valuation model as at that date. And that meant subsequently post-lockdown, we could actually look at the market separately as to the before and after COVID and really have an accurate view. And because of the slower volume of sales, we did an indices. And so we've created with OneRoof a velocity COVID market indices to track how the market is performing, enable us to make the most accurate decisions and understand what's happening. And it very much is a varied story looking at the composition of what's selling. So interestingly, the top end of the market is very much a wait and see. So areas like Remuera, Parnell are pretty flat. No one's really selling. We're not seeing home movers. And conversely, the bottom end of the market, so first home buyers and investors are very, very active, have been the most active in the market, which can drag down, obviously, the median sell price because the properties that are selling are low valued. And so that's what we're currently seeing.
That's really interesting. I mean, Tony, what do you make of it? What is keeping the property market stronger at the moment? There's obviously a huge mix of forces in there, as Carmen's just pointed out.
Yes, yeah, exactly. On the face of it, you wouldn't expect this degree of strength in terms of the prices flattening out rather than really falling away to any great degree. And of course, the level of sales being quite so strong. I think there's a number of things out there. One would be that interest rates on average are about 1.1, 1.2% less than a year ago. Obviously, the Reserve Bank cut by 0.75% back in March, for instance. And that is relevant not just for the owner-occupiers looking to buy, but for the investors who not only are seeing low term deposit rates, they're still falling those term depot rates, and they're expected to remain low for years. So there's a general movement of money looking for some better yield than what you can get on a low risk investment at the moment. Also, for the first home buyers, there's been the removal of the LVRs, which has made them confident that they're going to be able to make a purchase with a relatively low deposit. So far, the banks haven't moved all that much. There's a little bit, but they haven't moved all that much on reducing the deposit requirements. Maybe that's something which could come along with spring mortgage campaigns, something like that. There's also, of course, a big queue of frustrated buyers. And with this shock coming along, most people are not badly affected by the fight against COVID-19. They might look around and be a bit embarrassed about it for a while, but then they'll remember, I've been trying to buy a house for the past 5 years. And so they've sort of sniffed an opportunity of getting into the market when they're hoping other people won't be there. And of course, finding that the auction rooms are relatively full and the open homes are quite busy, but that queue of frustrated buyers is highly relevant. Another big factor, I think, is the fact that we Kiwis were going to spend about $10 billion on overseas travel in the coming year, and we're not traveling overseas. And we're thinking, well, when will I travel overseas? And we're reallocating that towards domestic travel, some high-end motor vehicles, it seems, spas and gazebos around the place, and also people looking at picking up maybe some domestic holiday homes and just gearing that money into the housing sector as well. And then there's one final factor, which not many people have really picked up on this, because the prevalent view is that well, surely with the borders closed, the net migration inflow for New Zealand is going to be zero, if not, worse. And that's going to be a big driver downward of the market. But what was happening with our net migration numbers, even before we had ever heard of COVID-19, was that in the second half of 2019, fewer Kiwis were leaving, more were coming back from overseas, and there was actually an overall migration boom. And what I've done is I've added up the numbers for I think it's the 17-month period from the start of 2019 to May 2020. For New Zealand, there was a net migration gain of 102,000 people. Now, most of us analysts have been thinking, well, by the time we get to the middle of 2021, a 30-month period, that's when all the numbers will add up to about 102,000. So we've got all these extra people already in the country, and all of us can see that there are many of the 1 million Kiwis overseas who would just love to be back here at the moment. So I think that also is a pretty strongly supportive factor in the market.
Oh, yes, that's a really good point. The people who want to come back right now, and that's keeping the numbers of people looking for a house quite high. I mean, Peter, what are your people seeing out there on the ground? As these guys have already said, there is a big queue of particularly first home buyers who've been trying to get into the housing market for a long time. A lot of them anecdotally seem to be thinking that maybe now is the time. And yet there is also lots of people saying there just aren't that many houses to list. So is that what your people are seeing on the ground?
Yeah, I think if I firstly go on Carmen, I think what we're seeing, we've just released our July figures today, and what an unbelievable July we had. We were one sale down on what we had in March of this year, and when we go back to March prior to COVID, it was almost getting into the record-breaking months of number of sales and the number of listings. And what we're seeing is, I tend to disagree with Carmen as far as the high value properties. We are starting to see more of the high properties in the Remuera, the Epsoms, the Parnells, etc., coming on the market, because some of those buyers are now either moving up, getting the opportunity to move up or down, depending on whether they want to take on more mortgage or less on it. But equally, the first home buyers, and I think Tony made a very good point about the fact that we're not going overseas. I think it's giving an opportunity for some of those young couples that were planning an overseas trip, that are deciding, hey, we're not going to most probably get there now for maybe 2 or 3 years. Let's put that money that we invested on our trip into a property and get into the property market. And I think, so what we're seeing is this price spectrum right over from the early 500s right through to the multi-million dollar properties that are moving. Equally, the number of listings that are coming on was one of our record July by almost 2 to 1 over last year. So the listings are coming on, but we're selling them at the same rate.
Interesting. Rupert, what are you seeing from the people who are coming through your doors? You know, are first home buyers feeling hopeful? Are existing homeowners feeling worried? What's the mood like?
Yeah, Tony was exactly right. The mood has changed from extreme enthusiasm as the LVR restrictions got lifted and people were still employed post-COVID, and there was going to be a bunch of mortgagee sales and they were going to pick up a deal and everyone was saying 10% drop, to frustration that, you know, the LVR restrictions didn't apply to them. It was just to protect the banks from those mortgage holidays and mortgage deferrals. You know, not everyone lost their jobs, so there are a bunch of buyers. You see the queues at the door at the open home, and I think it's that transition that has really caused that from absolute enthusiasm, and we got overwhelmed post COVID, post lockdown by inquiries, to it's just not going to be as rosy as we thought. Now, one of the key things is the bank finance. They haven't made it easy for people to borrow. I think that's correct of them. I think they needed to protect from people just going absolutely crazy. But again, another sort of source of frustration for those first home buyers, particularly in that over 80%. It's, if anything, a little bit harder than it was in February or March, because the economists are still saying, well, we don't know what's going to happen in Tony may be able to correct me, but we're not quite sure what's going on, and it may still drop. So we can't be lending at that 90% responsibly. And so this is really frustrating from a first home buyer's point of view. So there is that transition in feeling.
I think when you say there as well about people not being quite sure what's going to happen yet, one of the timeframes that people have been focusing on a lot of commentators saying September is the month to watch. And I mean, I'll put myself amongst those. I've written a couple of columns saying keep an eye on September because nobody's really sure what's going to happen. The wage subsidy ends then, the mortgage holidays end then, although they may be extended. And there's the possibility that some of these support mechanisms come away and things might change. Tony, what do you think? Do you think things could change then? And do you have an idea of which way they might go?
Yeah, I think that with a lot of the positive indicators we're seeing for the New Zealand economy, I'm not talking about overseas, but for the New Zealand economy, a lot of people are sort of clutching at straws now as to what could generate the negative scenario I was so scared about 3-4 or so months ago. And people are trying to focus in on the September timetable there. And I don't think it's going to be the big negative that people are thinking. And if you look at the wages, the subsidy coming off there, well, anyone working in a firm where you're still getting the wage subsidy, you'll know that the sales are more than 40% down from a year earlier. And you'll know that there's a reasonable chance you're going to get laid off come September. So you've probably already adjusted your spending for that. And you will not have been out there in the market attending the auctions and open homes already. So I guess I'd put that in there. And also I'm coming across businesses who, having laid some people off, are now starting to hire again, and they're remembering their biggest problem before COVID-19 was sourcing skilled, unskilled, unmotivated, whatever staff out there. And they're looking towards one day, things are going to be more sustainably stronger for their business than they are now. So I do expect that the labour market generally is going to still be pretty weak out there for the next 18 months, but I don't think we're looking at falling off a cliff come September by any stretch of the imagination. And the same goes for the mortgage deferrals. Now, the Reserve Bank, I understand, is in discussion with the banks about this at the moment and maybe is going to make an announcement within the next couple of weeks. There is a very high probability they will allow the banks to run some lower than otherwise capital levels so the banks can extend the mortgage deferral scheme for another 3, 4, 5, who knows, maybe 6 months if needed. But the new people applying for deferral, the numbers are now pretty low, and they have been for a while. And the banks, well, given that they're not seeing the prices falling away, are probably feeling reasonably secure about their security for the mortgage. So frankly, are probably going to be quite willing to extend that mortgage deferral interest only principal repayment period for a while longer. So no, I don't have a concern about that. And I think at the same time as maybe the absence of those two big negatives for September, well, September, it's the start of spring. Banks traditionally do some version of a spring mortgage campaign, maybe some small rate reductions in the 1 to 2 year fixed rate area. Maybe, I guess I'm hopeful come September, a little bit more passing on of the LVR change there, but also the test interest rates banks use. You might go along to the bank and try and borrow 5 years at 2.99% fixed, but they're going to work out your serviceability at 6.5% or 7%. I think we're getting close to the banks starting to drop those test interest rates a bit. Maybe that's what spring will bring.
Very interesting. And there's certainly so much happening there, and it's also tightly linked to employment. I mean, house prices tend to be driven by that a lot. Carmen, what do you think? Is there the possibility of a two-track housing system developing where we see good news in regions that aren't as reliant on tourism, where those businesses are rebuilding, and less good in the regions that were reliant on tourism? What do you think? Do we have any indicators on that?
I think it's important to recognise the strong market that we had early on in this year. So, if you look at March, the previous 12 months, more than half of our regions had double-digit growth, which is absolutely quite significant and such a strong, entry point. Currently now, a lot of them have dropped away, and we're seeing, we've seen the nationwide drop to about from 9% to 0.05%. But we're still seeing steady, flattening in the regional areas and the urban areas. And it's more Dunedin, Queenstown Lakes that we're starting to see a real slowdown and softening in those markets. So it's very much going to be a story of regions and obviously the contributing factors around that. I guess if we look at worst case scenarios and say, well, if people in those regions are forced due to employment issues or economic issues to sell their properties, which no one wants to happen, especially if someone is forced to sell. When we look at the entire market and look at how we model valuations, quite significant that in the last 2.5 years, only 12,500 properties in that period sold for less than what they bought for. Well, that's not saying, did somebody overpay because they got excited at an auction, or was there some circumstance that forced them to sell? It's a very, very low number. If we look at what the market is now today, only around 60,000 properties are valued at less today than what those people bought them for. So if we're, again, to put it in context, if we're worst case scenarioing, even the worst case scenario is, will there be someone else to come and buy that property, whether it's a first home buyer or an investor or somebody else? Actually, so I guess it comes back to that old adage of New Zealand property does hold its value. We have had a very, very strong market. So certainly we're going to see a slowdown. We also have the election coming in September, and we've always seen every single time we have an election, people pause. They wait and see what's happening, and it affects our decisioning. It brings uncertainty. And when we have uncertainty, the market does slow down. So we have those multiple factors contributing to so many different things across the regions.
I think your point earlier, Rupert, about banks being quite careful that they still wanted to lend responsibly is, as much as that might be frustrating for some people who are close to the edge and can't quite get there, it is still heartening in terms of big picture view, because there is the risk of people overextending no matter how well intentioned they are. If things are to go wrong, I mean, how serious does it have to get for banks to start having some of those difficult conversations and possibly even progressing to a mortgagee sale?
Well, typically in the past, if you've been 3 months late in your mortgage payments, then the process begins of selling your property. I think the banks absolutely don't want mortgagee sales, right? It's bad press. They get bad prices for the securities they've got. They will do whatever they can to avoid it, and they are looking to extend those mortgage deferral holidays. I think you'll start to see some tougher conversations about those mortgage deferrals in terms of they were very easy to get, but you'll probably need to prove that you have continue to be significantly affected by the COVID hardship to extend that. They don't want people sitting on those forever. So the banks will be starting to gear up to have those conversations, and this is just the first step to make sure that you don't get that run of mortgagee sales in another 3 or 6 months' time, however long the extensions get done for.
Peter, are there any opportunities in the market at the moment, and also do you see any potential pitfalls?
The opportunities, I think, and we've only really referred to residential so far on this meeting, but it was interesting to see the huge increase in the number of rural sales we did in July, and I think a lot of that is also a change of lifestyle. Through COVID, we learnt many ways of doing Zoom meetings, etc., and people were able to operate more from home, and I think it's just given people a different perspective of what they could be doing. So we start seeing people moving into in Auckland, the Coatesvilles, the Albanese, or further up North Auckland, or even South Auckland and the Pukekohe, Tikawata areas, where they can buy a little bit of a larger land area, have a bit of a few animals on it, and have a more comfortable lifestyle that they were looking for. So there's that sort of opportunity is out there. Pitfalls, the only thing I would say is we've got to be mindful of what's happening in Australia, in Victoria, Adelaide, Sydney. If the virus does get out there, what will that do to real estate if we have it back here? And that's the one thing is in the back of my mind. We don't want to go into another lockdown, but if it's for the sake of our well-being and health of New Zealanders, if we did get in that situation, I hope we went into it quicker than not, and just clear it out and start again, because we're seeing it worldwide that, through our association with leading real estate companies of the world, we're hearing what's happening around the world, and real estate across the world is very similar to what we're seeing here in New Zealand. But what we're seeing, those countries that have gone through lockdown, have gone sharp down and then sharp up like the old V shape, where it's gone into a second lockdown, we see that as the start of the W, but the uprise of coming out of that second W is not as strong as what it would be from the first one. So that's just something that we need to be mindful of. We have talked about the election and, what is that going to bring? Is it going to be Labor by themselves? Is it going to be a Labor Greens? Will we see capital gains tax come in? Who will know? Or if it's going to be, the three-way or national even coming up, who knows? But I don't think the election will play as big a part this year as it did 3 years ago. That was quite a major, because it wasn't so much about the election, it was the time after the election that took quite a while for the parties to get together to form a government. Hopefully this time things will be sorted before we go into the election.
It's interesting what you mentioned there about the opportunity with rural properties particularly, and some people looking for more space. I saw some research that was taken, I believe it was in April, but pretty much directly after lockdown. One of the only spending categories that went up was home and living, because people looked around those same four walls for 4 weeks and decided there's a few changes they wanted to make. So I think we're all a little focused on the home zone at the moment. Carmen, that point about the dangers of a second wave, particularly some of what we're seeing in Melbourne right now, I think spooks some people. What risks do you see for the property market in the months ahead, and is there any way that people can prepare for them?
I think that's a really important point. And certainly for ourselves, where we've got global offices, we don't take for granted our predicament here in New Zealand. We're in India, they're still having over 50,000 cases a day. They've been in lockdown since March. And our team in Melbourne, it's certainly the mental and I guess the uncertainty around going into another lockdown cannot be underestimated. And I guess that's where all of us are probably so vocal and emotive around the protectionism of our people and our health and our economy, because it's actually so important. To Peter's point, no one wants another lockdown, and the entire industry came to a halt. We were talking before we started recording, velocity values the New Zealand residential market upward alone, just residential only, not commercial and agricultural, upwards of $1.35 trillion. So it's a significant contributor to jobs, to real estate, to valuers, and to lending, and to people for their homes. So it's a really important part of the economy. So I guess, what will come and what we need to be thinking about. On the positive, those low interest rates, the responsible lending that our banks have, and I guess the slower volumes of listings only continues to increase demand, in combination with, to Tony's point, that increased, migration of New Zealanders back to New Zealand as this is the best place to live in the world. Conversely, slowing off construction, understanding what the rental market is doing, and not having that tourism spend in some of the other areas like our Queenstown, like our Rotorua, is undoubtedly going to impact our economy. And because we're such a small economy, whilst that might impact values in those regions, there is a flow-on effect that can't be underestimated. So, as many of the firms are nationwide, and we're very, very small. So I guess it's going to be a wait and see. Probably my key point would be, not to take heed on the doom and gloom or, any headlines. And I guess that's what we love about working with OneRoof, is let the data tell the story. And, I think we've all learned that lesson when we were in lockdown and people all thought it was going to be doom and gloom, and they were wrong. The reality is no one knows. We have to watch and see, and there's just so many things that can impact the numbers. And so actually looking at real data, valid data that's grouping it in a proper way and making an informed evidence-based decision on your own should be how you decide what you're doing and what's right for you, whether you're an investor, first home buyer, or property mover. I think that's probably the best outtake, because nobody actually knows. None of us has a crystal ball.
Yes, and Tony, things certainly have looked far more positive than people expected, certainly, and even quite positive on its own terms so far. Things can take a while to shake down in property, though, and to reveal itself. So if we were to avoid a second lockdown, let's just take that positive view of things, do you think that if we were to avoid that, we are out of the main danger zone so far, or are there still other things that you're watching for?
Okay, I think I'm prepared to say we would be out of the main danger zone in terms of the greatest period of weakness in our economy. March quarter and June quarter is when that was the case. And I've been inviting people to remember that New Zealand is a primary sector-based economy, and the demand for our primary products, still minimally processed overseas, is good. It's holding up very well. We're seeing a lot of investment going into the horticultural sector. We're seeing extra training courses being provided for people to engage with the horticultural sector out there. So when I look at our export base, the tourism, it's gone. The international student market, it is maybe half gone. And at some stage, however, as each month goes by, we're going to be thinking, but bits of it will start coming back, maybe 2022. And that'll start to become a little bit of a positive in our own minds compared with what people have been thinking in recent months. I guess I'm optimistic about a vaccine being developed and slowly administered overseas. That's why I think 2022 for the borders, not 2021 of an opening up there. We've got a lot of industries in New Zealand with very strong underlying growth, such as the space sector, putting satellites up in orbit, games development, aged care sector, the healthcare sector, a lot of rejigging also in the economy. One of my key themes for the past 3 to 4 years has been that a period was coming for New Zealand of weeding out or restructuring across all sectors as businesses adjusted to online competition, loss of pricing power, social pressures, etc., staff shortages, finance harder to get. And all that restructuring is happening right physically now. And out of all this, for 2021, is going to come, I think, some pretty high levels of efficiency across all sectors in New Zealand, which will leave us well positioned for A, growth in 2021, and B, an ability to gear up that growth when the world economy recovers more generally, maybe 2022, tourism, etc. So I guess I'm still definitely of an optimistic bent on this, and it would have to be, I think, an outbreak in New Zealand and a new lockdown to greatly disturb me personally from that optimistic scenario.
Well, that's certainly reassuring to hear. Rupert, I think in times like this, whether you're a hopeful first home buyer or you already are a homeowner, I think general financial stability is probably pretty good for everyone right now. It's, like you pointed out earlier, the banks actually don't want to sell your home either. They would like to avoid that. But it's very much, I think, one of those plan for the worst and hope for the best situations. So if there's anyone out there who wants to just increase that security, batten down the hatches a little bit and make sure that their home ownership isn't threatened, is there anything they should be doing right now?
Yeah, that's exactly what it is. It's plan for the best, hope for the best, plan for the worst, rather. Yes, and it's really about it's never been a better time to try and get yourself into that good financial position. We've got low interest rates if you currently own a mortgage. At the moment, we are pushing our Aim for 8 campaign, which is aim for 8%. So if you can afford your mortgage at 8%, then you are set for the next 5 years, right? Now, that's not a promise, but it's a pretty good guarantee. Yeah, it's if you can aim to pay your mortgage at 8%, then you have enough buffer, and you're building up a buffer in the meantime while our mortgage rates are 2.55%. And if you own a house, it's about building up that cash buffer through the use of revolving credits accounts or offset accounts, so that you've got enough to last if we have a sort of a Victoria, Australia scenario again here. Now, In the oldie days, they told you that you had to last for 3 months. You need enough cash to last for 3 months. I suspect it's probably more 3 months plus a lockdown these days. So you're probably talking 5 or 6 months if it gets really out of hand. You need enough to be able to survive not only your expenses, but of course your mortgage. And if you can get to that point, and for first home buyers, it's really just your expenses for 6 months, right? But if you can get to that point, then the next worst thing that comes along isn't going to be as much of have as much of an effect on you. So you could afford to maybe be out of a job for a few months. Now, you want to be doing that today because the interest rates are low. If you're still employed, that is, you're building up that buffer. And I think a lot of people really got caught because we used to hear, what are the odds of that happening to me? I'm in a stable job. What could ever happen that would cause me to be out of work for 5 months? And the answer was in February, right? So people need to take that time, reduce their expenses, make sure that the amount of income that you've got left over at the end of the month is maximized. Get rid of those debts, get rid of those funny little subscriptions that you sign up to. You might have 4 different TV channels that you're subscribing to, and you can probably cut 3 of those for a while. Really focus on that. It's a very boring answer, I'm sorry, but it is the one that will see you through.
It's not boring, but then again, I love boring stuff, so who am I to judge whether that's boring or not? Peter, I would love to know, for anyone who is looking at all this and thinking, what's my move here? If you were talking to a buyer and then to a seller, obviously probably quite different tips for each, but what would be your big main takeaway for each of those people?
I think we'll start with the buyers. We've talked about the amount of money people can borrow these days, the low interest rates. I just say to people out there that real estate is a medium to long-term purchase. You're not going to buy it and move it on within 1-2 years. So medium term, we're looking at say 3 to 5 years, longer term, more greater than 7. And I think when we look at mortgages, don't overcommit yourself. The interest rates are low. They talk about being low for maybe 2 or 3 years. But when you take a 10, 15, 20-year term loan, there is going to be an increase in mortgages through that period of time. And that is when we start to see people get caught and, dare I say it, get into the mortgagee sales situation. Having been involved in a large number of those over the years, it's no pleasure for us having to act and sell those properties, because not only do we know how hard the banks have worked to try and help save the people, but mentally and physically, the people that are losing their property, it's not a very pleasant thing. So just be careful, don't overextend your circumstances. The other thing is, you might be, especially with first home buyers, where they're buying in together, maybe a couple that are going in, one may lose their job, or one of the ladies might become pregnant. So the income sort of capacity can drop, and then that can also put you in a situation of repayment. So just control and look at how much you borrow. But certainly, it is a good time for buyers to be buying property. Tony talked about people instead of going overseas. It is a good investment and good way of making up your capital gain. For the people selling their property, put your houses on the market now. There's no better time than now to put it on. If you're thinking along those lines, today is as good a time as it will be in spring, because there's a lot of buyers out there. There's a shortage of property on the market, and there's a good number of people that are wanting to buy property. So instead of waiting to spring, put it on the market now, test the market. You can always take it off and put it back on in spring, but I think now is an active time, and we don't know what's around the corner. That is the golden thing, is we don't know what's going to happen this time next year. If you want to move your property, the market's active, go with it.
Well, Well, thank you so much, everyone. I think there's been some great insights from our panel there. To recap, Peter Thompson from Barfoot and Thompson, Carmen Visilic from Velocity Global, Rupert Goff from Mortgage Lab, and of course, economist Tony Alexander. Now, if you want to check out the full OneRoof property report, there's always more than we can get to here, stats everywhere, and you can see what's happening in your particular region as well. Do check that out, oneroof.co.nz.